In this lecture, we'll learn some basic ideas that you might find useful when trading stocks. First, though, we need to cover a little of the mechanics of stock trading. A lot happens at the supermarket that we don't usually see. All we see is the food on the shelves. But the food doesn't appear by magic, you know. Somebody delivered it and put it on those shelves. Somebody kept track of who owned it every step of its way through the delivery. If it was a special order, maybe a cake from the bakery, then somebody took the order and saw to it that the cake was baked at the proper time. Most of the time, we don't care about any of that. We just want the item we want to be there when we want it. We want the best price possible, we want to check out as quickly as possible, and we don't want any mistakes. Just like in a supermarket, a lot happens behind the scenes in a stock market. Somebody is responsible for making sure the shares we want are available. Somebody will handle special orders. Somebody knows who owns the stock now, and somebody will record the transfer of ownership. Most of the time, just like at a supermarket, we don't care about any of that. We just want the item we want to be there when we want it. We want the best price possible. We want to check out as quickly as possible, and we don't want any mistakes. The TV commercials make it seem as if investors are directly connected with the securities markets. They click their mouse or press a button, and the trade goes through instantly. That's not quite true. The actual completion of a trade, called its execution, isn't immediate. When you click on your computer, your order is sent electronically to your brokerage firm. It's just the electronic equivalent of a phone call giving instructions. At this point, you haven't bought or sold anything. You don't even know the price. Before the trade can happen, your brokerage firm has to find someone willing to take the other side of the trade. After you place your order, it goes to one of 4 places for execution. The firm has to give you the best execution for your order that's reasonably available. The first of these 4 methods is the old standby, sending the order to the stock exchange. Your order gets matched to someone who wants to buy it if you're selling, or to sell it if you're buying. The second route is through one of more than 500 market makers. Market makers are companies that stand ready to buy or sell at least 100 shares at its posted quotes. Their buy price is a little lower than their sell price, so the company can make a profit. The difference in the buy and sell prices is called the spread. Routing trades to a market maker is more common for NASDAQ or other so-called over-the-counter stocks, which tend to be the stocks of smaller companies. Third, your order might go to an electronic communications network, or an ECN. An ECN automatically matches buyers and sellers who agree on price. This is fast because computers do the work. Fourth, your broker may internalize your order. This means your broker's firm has the shares you need in its own inventory already. In this way, your broker's firm may make money on the spread, the difference between the quoted buy price and a quoted sell price. After your order works its way through one of these 4 routes and finds a counterparty, the order is executed. The actual exchange of money and securities occurs later. The entire process of routing your order through the markets to find a counterparty is usually blindingly fast. It often takes less than a second. Prices can change quickly, though. What's more, the price quote you saw on your screen or got from your broker is for a specific number of shares. Either the timing lag or the size of the quote can cause you to get a different price than you expected when you placed your trade. The second portion of your transaction, called clearing, occurs after the trade is executed. Wall Street uses the word clearing to refer to record keeping and transaction services between the time you make your trade until settlement, which is when the money and securities officially change hands. Clearing involves stuff like reporting the trade to appropriate entities and confirming that the trade meets any legal or SEC requirements. Of course, all brokers keep their own records for all of their clients' trades,